Hey, welcome to this week's episode. So I very briefly mentioned our fixed second that we rolled out last week. And as you know, we've been doing HELOCs for a whole bunch of years now and done a whole bunch of them. And they save people, put them in better financial situations, which is great. So now we have another option. So what are the differences between the two? Well, if you're familiar with HELOCs and how they work, they're essentially just big credit cards on your house. You have a credit limit and you pay on the money that you use. Pretty straightforward. Some of the cons to them is they're tied to prime rate, and those rates are pretty high right now because prime rate is directly reflective of where Fed funds rate is. And if the Fed doesn't move that rate, the prime rate isn't going to move, and your HELOC rate is not going to move. So there's some kind of pros and cons to that side. If you flash over to the second mortgage, it's a fixed amount of money that can be based on a 20-year term payment, also a 30-year term, which people seem to really like. And it's a fixed full principal and interest payment, not an interest only payment. And I think one of the biggest differences in looking at a bunch of these is it's not as conservative in qualifying. It will go to a higher debt to income ratio, for example, than a HELOC. A HELOC will use a payment that is much higher in qualifying purposes. That oftentimes, I would say half the time, kicks people out of qualifying for a HELOC that would now be able to fit in with a fixed second mortgage. So you probably have a great rate, you probably have a ton of equity, and you'd like to access it. And I think right now, between the HELOC and the fixed second, they're both great solutions. I'm really liking the fixed second right now for a whole bunch of reasons, but just wanted to share a little bit of detail on that. So if you have any questions, happy to have a conversation and see if this is something that might help you out. Talk to you soon.